podcast. I'm here with Toby Chapple of Zerocap. He's out in Australia. Toby, how are you doing?
Good. Yourself?
Doing well. Super happy to connect. I think you have a really extensive background, and I'd love to kind of dig into that and learn about how you got into trading and what kind of roles did you have throughout your career, and then kind of jump into Zerocap and what you do now.
Great.
So, kind of starting it off from the beginning, when you were in university, did you go straight from uni to trading, or was there anything in between? And did you know that you wanted to go into trading?
No, I pretty much knew. I mean, I was like a master in econometrics majors and stuff, and I actually got my first job as an interest rate swap trader and an options trader as the first book I ran, which is probably not the best way to start your trading career in the complex stuff, but it was super fun. So that gave a really good background in sort of financial engineering and mathematics and the opportunity set that's available in the market. So that was pretty cool. And then it became very, very apparent to me early on that proprietary trading was much more fun than doing client flow. And so then I just dived into proprietary trading. So I've spent, close to the last 20 years working at, investment banking or hedge funds as a global macro trader. I guess my notable roles, I ran proprietary trading for fixed income for Deutsche Bank, one of the five traders globally who run their risk. Had a couple of good years there, just running prop trade in the investment bank, and moved me across to go to my own global macro fund, which I managed for a number of years successfully. And I've also run global macro funds for Sequoia. My last role was at UBS, running over a large amount of money. I basically traded pretty much every single product in the world in terms of complexity and in some size, like from credit derivatives to everything. So tried to be a sort of a little bit more thoughtful than just going long or short, and trying to see what the opportunities are there in the market, right? So generally, we've done a lot of work in correlation and breaking down those barriers and what that means, et cetera, et cetera. But yeah, that was all good. I mean, I've done a lot of sort of mathematical-based trading as well. I mean, I was global head of Deutsche Bank's hedge fund replication suite of products, which was pretty cool. They were just running linear regressions against our pool of hedge fund risk, and you can work out what they were invested in each of these strategies, such as long, short, et cetera, et cetera. So I ran that for a number of years as well. We had some great models where we were arbitraging hedge fund fee structures by putting on liquid risk and shorting physical hedge funds. That was super fun for many years. I've sort of got a pretty diverse background. I've only been in crypto for about a year. I came back. I've just spent 10 years in the States, in New York and Miami, and I came back, just when, during COVID, and came back to Australia and took the role of head of trading here at Zerocap. So sort of, it feels like coming from traditional finance, you're YOLOing your career to go into crypto. But I'm telling you, I'm so happy I did it because it's just so much fun. And there's so much differentiation between traditional finance and crypto. And the thing moves around, that's just fantastic. So, don't regret the decision at all.
That's fantastic. So, I mean, there's a lot there. I would love to just kind of just dig in a little bit more into. So you were saying you were running global macro, basically global macro desk. So when you're doing those types of trades, are you looking at trades that maybe there's a convergence in yield over time, something that's like more of a pairs trade, or are you looking at kind of big picture themes and looking for a directional trade? What's the type of trading style at a big bank's proprietary macro fund?
Well, it's a bit of everything. I mean, your goal is to make money in any way you can find. But, of course, some directional stuff. But really the opportunity set is in any market, and delivering alpha is to work out, making money off other market participants' behavior is the best one. So, global macro is mainly about interest rates, FX and bond risk and some commodity stuff, right? And working out what's being priced in these different markets for certain different event risks and what's going on. And what you find is because of flow, you'll get one market that isn't pricing it as much as another one. So you can put together 2 or 3 different trades and get a payoff structure that has a much better risk return than just going long or short on a CPI number or something like that, because they will mean revert over time. So it's just trying to be a little bit more thoughtful on your trading processes and working out the correlation between different variables, some of overpriced, underpriced, and understanding that, and trying to get a methodical process around that with some pretty good risk controls so you don't blow up.
Yeah, that makes a lot of sense. And then you talked a lot about like correlations that you did, or like looking at opportunities within correlation and then running correlation against what hedge funds were invested in. So is that a little bit like trying to figure out how players are positioned, figuring out their pain points and looking for opportunities sort of at those inflection points? Or is it more like this is the relationship between gold and platinum historically, and now I expect this correlation to mean revert in the long term?
I guess with the hedge fund, we spend a lot of time looking at where hedge funds position, right? Because you want to know when they're wrong, because that's when you get really paid. So really just look at the hedge fund community as a whole. They're generally just taking the beta from their market and packaging it up as 220. Now, let me give you a simple example. Like a long short equity fund is long small caps and short large caps, because that's the only thing you really can short, and adding some cash to that, and that explains like 95% on R squared of their return profile. So at the end of the day, they're just harvesting the small cap liquidity risk premium. So you go across each of these markets, credit, bonds, and that, and you'll find out that really the market generally is packaging up risk premiums, and you can tell when they've gone too hard or too soft in some sort of stuff. So you can work out positioning and then take advantage of it if they think they've got it wrong and something's happened in the market. So that's really what we're doing for hedge fund, which is just fascinating being crypto now with blockchain, because now I know where everyone is positioned automatically, which is just one of the most amazing things in the space in blockchain. Is that I know where short-term traders are positioned. I know where long-term whales are positioned. I know where everything is transacted hands. I mean, the technical analysis on the back of that is just phenomenal. It's almost perfect knowledge, where in traditional space you don't have perfect knowledge, and you're guessing and modeling out where the risk parameters are to try and take advantage of it. But crypto's a lot easier.
Yeah, that's fascinating. Now, another aspect of that, like, so the blockchain data is completely transparent, and it's also such a new data set that I wonder if, is there a lot of people looking at this yet, or is this still on stones that have not been turned over yet? Do you think that you're one of the first people to really include this data set systematically into your trading?
I think they're all coming, and they're all coming hard with big hedge funds. Brett Howard just launched $1 billion a couple of days ago. They're all hitting the space. I mean, we have a team of like 4 quants, 20 developers, etc. So we're building out AI and machine learning models on the back of that, just using about 300 different points from the blockchain and letting them decide. So there's obviously a lot of work still to be done. A lot of problems with the traditional hedge funds coming into the space and using their normal quant models in here, because they tend to break down in the volatility of the space. But yeah, I mean, it's in some ways you can say we have perfect knowledge of market participant behavior on the blockchain, and that's going to be modeled out and taken advantage of, and it's happening quickly.
Yeah, that's fantastic. So maybe can you just give us a quick background of Zerocap, just so the listeners in the audience can have some context around, what is your firm doing now?
Yeah, so we're a pretty cool firm. We're sort of trying to be an investment bank for crypto. So we're not a bank, of course, but the investment banking community would offer, sophisticated ways to manage your risk. You went to Goldman Sachs, that offer you structured products, that offer you better risk return parameters by putting together a lot of variables in the derivatives market and packaging it up and selling it to you. Now, there's never been a market that needs it more than crypto. It's been around for about 5 years. We've got 75 staff. I mean, the basis of what we do is custody, is the foundation rock. We have fire blocks that people use. We also have Lloyd's of London insurance on our custody solution. We're providing custody now for a lot of institutions and family offices. We don't do any retail. We're only high net worth family office institutional flow. But the custody solution is pretty big. And then we have an OTC desk that's been running this past $1.5 billion in notional trading volume. and we have a number of asset management products that clients can invest in that control the volatility of crypto, because it doesn't really fit into a normal portfolio in traditional space. So if you can manage that volatility better, it's better. And we've got that in asset management. And for the last 9 months, we've launched our structured products desk, which is absolutely booming off the back of it. So I'd really like to maybe talk about that market and generally the volatility market in general and what the opportunity set is. I mean, what we're really trying to do is open up the space to traditional world, right? We've got we've got a lot of crypto natives that trade it, but not a lot of institutions. So we're positioning ourselves for that institutional flow.
Yeah, that makes a lot of sense. So you mentioned you guys just opened up your structured product desk. Now, obviously, the volatility landscape in crypto, not only is it nascent, but it hasn't really been figured out yet. Do you see, kind of from your own background, any major differences between the crypto volatility landscape and some of the other products you have experience with?
Oh, for sure, it's completely different. I mean, there was probably a day I still don't shake my head about why things trade the way they do in crypto. I mean, obviously, the elephant in the room is that there's a 100-volt product going on here. So that's obviously larger and obviously can be explained too. I mean, there's been other products that have behaved like crypto before in terms of their volatility profile. So it's not new. So, a great example that we run is like, if you look at gold futures when they first launched in like 72, it's almost the exact same volatility profile. So, we can map that and see like how long will this volatility last too, which is a really good question, right? So over about 4 or 5 years, the volatility in gold dropped significantly, right, as other market participants entered and that sort of stuff. So how long will we get this volatility for, and how long will we be able to harvest is a really good question that we ponder. I think that things move so fast in crypto that I think volatility will drop probably significantly over the next 2 to 3 years. I mean, when you think of the Brevin Howards coming in with their quant models and stuff, like when the first quant and relative value funds hit the equity market, it destroyed volatility, just the S&P 500, right? I think the entering of especially relative value and quant models is going to add significant liquidity to the bid offer on both sides. And so I don't know how long it's going to last. But while it's trading at 100 volt, there is just enormous opportunity set involved in it. Now, a couple of other really interesting things that I think that everybody knows, that there is gamma to the top side here, right, which doesn't occur in equities, right? If there's all gamma to the downside, it just creeps up slowly on the top side, right? So in crypto, there is traditionally more gamma to the top side, which is just like, shockingly unbelievable. And especially when you look at the smiles and stuff, and you get such a right tail risk profile in it. I definitely spent a month trying to get my head around that. And what actually the conclusion we came to at Zerocap is that the options market is definitely skewed to the top side. And a lot of people naturally assume it's because retail are just FOMOing up the implieds at the back in the curve. But I actually think it's been priced correctly normally, because you've got an asset class that can go to zero, right? So that needs to be priced. But then it can go up 1,000%. So you've got an asymmetric payoff schedule here in the options market that does not occur in other markets. And I think it's been priced very well to price, traditionally higher vol on the top side than the downside, because notwithstanding when it's going to free fall and the skew mix around. But definitely interesting to try and get your head around why it's being priced the way it is.
Yeah, that is interesting. A few things that I've noticed over the years of running GVol, I've noticed flat put skews. I've seen that a few times where like 5 delta is the price the same as 15 delta, same as 25 delta. I've seen that a couple times in long dated options. And then I like to make that FOMO argument sometimes myself. And kind of my thinking behind that is that we'll see the futures, like cash and carry return, get really expensive. So like in April 2021, the like 90-day future cash and carry was about 40% return, which to me seems like, why would you give away 40% just to get levered long? It's almost irrational. But do you have any thoughts on that, on sort of the term structure of the futures curve as well?
Yeah, I think the real reason it gets bid up is because a lot of people don't really have rails in crypto, or they don't want to hold wallets and that sort of stuff. So it's a very easy way both to get access to the rails in the crypto space and the leverage on it. But that trade's almost gone. Especially in Bitcoin and ETH, right? Because everyone sold it, right? It's free money. It is arbitrage. I've never seen arbitrage in my entire career before I got into crypto. So I think that trade's pretty much gone now because the weight of money has hit it, and more sophistication of that in the actual spot coins. But what is interesting is how price out growth in the market, right? How do you price out interest rates in crypto? We do have a yield curve in crypto, and everyone's pricing it differently. We have institutional liquidity providers that we get rid of our options risk with, and I know everyone's pricing stuff differently based on whatever yield curves that they're trying to put in, which is super interesting. That we don't have basic yield curves like we do, but we definitely have yield, which the traditional markets don't have.
Yeah, that is interesting. And something else that you mentioned that I find fascinating, that I'm sure is probably going to hold out to be true, but it's a good kind of big picture theme to keep in mind, is that there's going to be a structural kind of decreasing in absolute volatility over the next few years. And so part of the reason that you mentioned was Brevin Howard or big firms like that coming with their models and basically willing to add liquidity and kind of tamper the extremes down a little bit. What is there another reason besides just institutional flows that you think structurally volatility would come down in the next few years?
Well, I think we've got some good things in it, but obviously I want volatility to stay up there because I package it up and use the yields, right? So for me, it's a good thing if it stays around. But I think that the market doesn't have the same valuation metrics as what an equity market or a bond does, right? So we don't have these value metrics that would have like a value or relative value sort of firm to come in and provide liquidity for those things. So because those metrics aren't there, it's almost a complete flow market, sort of like old school FX markets were, right? So it just moves until everyone's panicked out or panicked in, right? So and because there is excessive leverage in the space and the liquidations that occur, I've never seen anyone run their risk by liquidation on an exchange and the cascading effect of it. So I don't think that's going away anytime soon, especially the valuation metric. But it is coming. The institutional flow is coming. Like the BlackRock news just over the last week of entering the market. That's 20 trillion. We were running some back the envelope numbers that even 10 basis points of BlackRock's Aladdin book hit crypto, it'd be like 80% of the daily volume, and they're all coming from buy side too. So I think the supply demand disruption is going to occur in the space, and it's all the demand's coming from instos that need access to the space now. It's an asset class that they need, that clients need access and want access to. So I think the institutional flow is coming, and there's positive negatives to that as well. One, it's going to force the price higher, definitely. But the other thing it does lead is to our correlation to global markets, which is a bad thing, right? Because now we're getting risk on, risk off behaviour, and we look like another asset class, which is pretty annoying when you try to sell it as an inflation hedge or something, because it's not showing that at all, and it's probably going to increase that correlation with markets.
Yeah, that's a great point. So one of the arguments I like to make, sometimes traders ask me, why would I trade crypto when newer traders, why should I trade crypto versus stocks, stuff like that? And often my answer is that crypto hasn't really been figured out yet. And how do you value these things? And what are the correlations going to be and stuff like that? Now, you mentioned you did a lot of correlation work. Do you think that the correlations that crypto has with risk on, risk off, is that set in stone? Or are correlations too dynamic right now to really have like a strong prediction on how these things should behave in the future?
That's really interesting question, right? So like at Zerocap, we offer options and structured products across the top 50 coins. I think we're one of the only few firms in the world to offer a vast array of optionality to our client base in all these coins. Now with that comes hedging difficulties. Obviously, we can hedge the delta on it, but we have to run correlation risk with the liquid BTC, ETH, and SOL that are liquid to run it. But so we look at the correlation dynamics of the whole space and how they interact. Now, it's pretty interesting that there is enormous breakdown and breakup correlations, especially across the old space, because there is individual information that is occurring in those coins that is different from the whole thing, right? So if you take it from an opportunity set question like you met, you can say, right, let's say you want to be a long short manager in equity markets. They're all 100% correlated to each other in some way, shape, or form. Some have higher beta, some lower beta. But in crypto, there's enormous, I think, opportunity set just in the relative value sort of space, so long short models and those sort of things, because there is enormous correlation breakdown and outcome across the whole space. I mean, there's even correlation to breakdown between ETH and Bitcoin. I mean, obviously we've got the merge going on to explain it, but that's enormously fun and an opportunity set that isn't there in the other markets.
Yeah, that makes a lot of sense. And so, kind of speaking on correlate, just real quick, couple more questions on this correlation topic. So, one of the things that is a good theme when investing in Ether is that Ether is almost the index. It's like the ETF index of DeFi. Now, is there opportunities of going long short ETH versus ERC20 tokens? Is that something that you guys look at? Is that sort of a strategy that people do?
Yeah, I mean, there's enormous complexity that goes through all this sort of stuff. But yeah, I mean, ETH is what it is. So you can run long short against ETH. I mean, the whole street is using ETH as a liquidity point against that, right? So and then we've got, of course, all the perpetual futures and futures we have to hedge our risk and that sort of stuff. But yeah, I mean, there's the breakdown up of correlation is a better risk return trade-off, right? If you go long short and this stuff, you don't have to take the beat of the market smashing around every day and get direction wrong, right? You can just take and try and what you're trying to do is make sure your view as a trader comes out in your P&L, right? You don't want to go, I think this is going to happen, and then suddenly some global event happens and you lose money. That really sucks, right? So you want to package up, long short risk and whatever you can do to try and minimize the increase the probability of your view and whatever you wanted to put a trade idea on or whatever you did. And I guess that's the basis of what we do at Zerocap, really, and our structured products that are just fascinating in the structured product environment too, because structured products have been around in investment banking for like 30 years, right? So I'm actually not even inventing really. I'm just taking all the traditional approaches to structured products and putting them on crypto, and they work like 10 times better, right? They work 10 times better because there's 10 times more vol, right, in the market. So there's no vol and there's no yield curve, but we have it. So of course, we were talking about the gamma skew on the top side. Like, I can collar an investment for my clients and get paid to do it. Like, it'll cost you enormous amounts in the equity to do that because of that spread. So that's enormous opportunity just to collar your investment if you don't want any aspect of risk over a certain time frame. We just launched just to give you some indications of the trades that you can put on now. Principal protected notes was super popular pre-2008 in traditional markets, right? And they're very simple structure. They're a zero coupon bond, which is basically you just say you get 90 cents, you lend it out for a year, get back $1, and you use that premium to buy a full call spread. And so you get, at the end of the day, the investor will get their money back if the market falls, but they get some aspect to the long position of it, right? Now, they can't put really these on in traditional finance because there's no yield to make that zero coupon bond. But, we've got lending rates for, USDC at 8%, 9%, right? So we can package that up and start selling principal protected notes now for a client base with no downside to the market, only upside. So just a simple example of what we're doing in structured products that is just phenomenal. I mean, we get different payoff structures of, you only lose 50, you only take, 30% of the downside, but you take 100% of the upside. So just, packaging up this risk in a traditional framework, it just changes the whole risk-return relationship of investing. And it, as I said, it works so much more because there's so much more volume.
Yeah, that makes a lot of sense. And when you guys offer structured products to your clients, do you often find yourself sort of hedging out on Deribit using vanillas, or is it basically like doing some hedging in the underlying, or does it depend on the structured product? How does that work?
Well, I mean, I think as a general rule, we don't like to hold any assets on exchanges, right, for obvious reasons, right? So, and neither do our clients. We mainly deal, just with institutional level counterparties on the street in OTC format is what we like to do. Occasionally it's Paradigm, etc. But But we prefer to deal one-on-one because then we can monitor the credit risk that we have with our counterparties, which obviously over the last couple of months, credit risk is now important. Why you do that sort of stuff. But we have a very sophisticated desk here. We've got a former, head of a desk at Optiva, very big options shop. We've got 9 or 10 traders on the floor. So we generally hedge our delta risk and our Greek risk across the whole book that we're running, just like a professional options book would be run.
That's fantastic. And then you mentioned that Zerocap had 75 employees, and you guys are headquartered in Australia. Is that right?
Yeah, we're headquartered in Melbourne, Australia. We just launched our European desk only last month.
Cool.
Our client base is mainly family offices and institutions and very high net worth. So we've got a very specific target market client base. So 75 and growing.
And if someone wants to kind of reach out to you guys and potentially do some trades with your OTC desk, like what's the best way for people to get in touch with you?
You can just click on the website. There's a chat box. We've got a full front-end portal system that's equivalent to the bank. So you can just click on that's probably the easiest. You can also write help@zerocap.com. We'll get someone's attention pretty quickly.
That's fantastic. And then just kind of one more question before we jump into some more personal stuff. Does Zerocap also do stuff on Paradigm? I heard you mention Paradigm, but I wasn't clear if I understood that correctly.
Yeah, occasionally we do when we get sizey orders. Sometimes we'll use it. But as I said, we try not to put stuff on exchanges so much. But that's it. We do. We're basically hedging out delta risk with all exchanges as well. So it's a phenomenal platform. I mean, the whole space is phenomenal. The growth in just financial engineering is just phenomenal across the space. So I love it. I mean, I'm just off topic, but I'm first seeing a perpetual future. I hadn't seen one ever in my life. And then look at this. Crypto's gone and made a perfect future that's just fantastic. And now I think they're selling them into the traditional space. So there's a lot of financial engineering. I mean, obviously there's a lot of stuff about the algo stablecoins falling over. But it's a science. There's a lot of science experiments going on here in finance that are doing it. So, but that's pretty cool.
Yeah, that is pretty cool. And it's funny to see the perpetual future. I mean, that is the industry standard in the crypto world, and it's where most of the open interest is as far as Delta One products go. So kind of just a more personal touch here. When you first started getting into trading, and if someone's trying to get into trading, do you have any books that really stuck out to you over your career or that you would recommend newer traders to read?
Oh, there's only one, mate. Reminiscence of the Stock Operator in 1923 or 33 or something is a phenomenal book. Just teaching you how to read tape, right? That's your first thing that you really got to learn. I just love that book, and that's the one I definitely recommend. It doesn't go around. It's super funny to see how they were just sending telegrams to each other on tickers, on prices, and someone would get in front of that telegram and trade it and stuff. It's a very fun book.
Yeah, that is an amazing book. Jesse Livermore and his crazy up and down career. It's a really good book. I remember they had us read it at one of the prop shops that I used to work at. That's very cool. And then kind of last question here. So Toby, obviously Zerocap keeps you really busy. What do you do outside of trading and work if you find time to do anything?
Oh, I play cricket. I'm a cricket nut. I'm going to say you're looking at the Muckleford Cricket Club B-grade batting champion last year. I got a very nice little trophy. So, but I'm a cricket nut. I'll watch it any day of the week. I watch 5 days of cricket. To Americans, it's a very, very bad, crazy sport. But to me, I'm addicted.
That is awesome. Yeah, that was not the answer I was expecting. But are you? And then, is there a cricket scene in New York? You mentioned that you've been in New York recently.
Yeah, I lived in New York for 8 years. I know it like back of my hand. Good town.
Cool. Love it.
You're in Chicago, mate. Chicago's a good town too.
Yeah, absolutely. It is. Both are very good. Well, Toby, I want to thank you so much for coming on the podcast. I think this was really interesting. I think you had some really good, insightful stuff about the surface of volatility. So really appreciate that. And then one more quick question. Is there a Twitter that people can follow you at?
No, really, the Zerocap Twitter feed is what we put our information on. So you can find that on the website. Zerocap is the way it is. So that's what that's the best way to follow us.
Awesome. Well, thanks everyone for tuning in, and Toby, thanks again for coming on.